Hi, everyone. Hope you guys are doing well and that you've all had a pretty exciting, profitable week so far. And let's get started. Let's jump into the markets and see what's happening. Now, I don't know if you've been, if you trade in the euro and if you are keeping track of what we have so far. What we see here, for me, really demonstrates the power that we have in understanding price action and how we can start to get our minds formed and tuned and prepared to trade by what we see in front of us. This level here is a key level insofar as price action is concerned. In fact, no matter how you trade it, if you trade in the euro dollar, you should have this marked on your charts one way or the other. It's a key level at the present moment. It's a key level of resistance because the bulls want to get above that, but because they're failing to get above that, that level is a level of resistance. Now, whenever you have a level that the market bounces off a couple of times, you should note that because that's going to inform how you trade off that. Now, we had that bounce this 3-4 days ago, but have a look on the left. Look to your left before we got there. At this level, you should have, by the time the market turned down, you should have just marked that. I use a light blue level just to keep it, I don't want my charts cluttered and with so many lines on it. So light blue works for me because, the market broke below, we had this breakout. Let's start there. We had this breakout and we had a pullback, and then the market attempted to resume to go for the measured move. And the measured move of that breakout is down here. You could also just put your first leg, second leg. So there is the first leg of that breakout up to where it ended. And there's a pullback. Okay, so that level, which we eventually got to, this was in June. And, we kind of got into it last month. So if you've taken any trades, and we've spoken about this before, and you want to hold on to your trades, that's where you'd be taking profits. So when the market turns there, it's no surprise, right? Because of the measured moves. But look what happened. The market went sideways. The bulls attempted to reverse the bear breakout. And if you were in the market at this particular stage, you would have noticed all sorts of interesting price formations here, an attempt to break beneath that. So that's a lower low double bottom. It's a wedge low, 3 pushes down. Market went down once, attempted to resume, went down again, attempted to resume. So that's a wedge. So it's pretty decent setup for indicating the bulls having strength. That market repulsing, preventing the bears breaking to a new low 3 times. So at that particular point, you'd be saying to yourself, hang on, the bulls might be strong. And if they're strong, we're going to see a reversal pattern forming up. So they did evidence that clearly at this point. So let's just plug it in so that I'm not talking what's in my head so you guys can see it. So that's a wedge pattern. Okay, we had this low here, an attempt to break beneath it. First attempt to break beneath that failed. Market went up, bears tried again, reversed. So that's the second attempt to break beneath that level, failed. Then at the moving average, the bears attempted again, failed. So 3 attempts to break beneath the level. That's a wedge pattern, a 3 push pattern, significant in terms of giving us information in terms of who's controlling the market at that particular point. Going sideways, but the bulls are preventing the bears from breaking out. Then with a micro double bottom in here, inside candle almost, and the reversal close above the moving average, decent enough setup for the bulls. right here. If at all you're going to take a trade here, order, put an order above that, and your stop beneath here. And what are you expecting? You are expecting, you are hoping it's a major trend reversal. You know the profits, the 60-40 ratio in terms of major trend reversals. So if I take 100 trades of major trend reversals, 60% of the time I will lose. But of the 40% that I win, I'm hoping to the market get up there so I can add into my trades and make some very good returns. Unlike, if you got a breakout pullback, then it's the formula, the risk return is inverted or changes, rather 60-40, so 60% chance of success in that kind of market that you'll make money. So we've covered this before. So you're hoping for acceleration upwards, but then it fails. So you've taken a trade, you're triggered in, and you're hoping for follow through, and then the market fails and starts to go sideways. Now, at that stage, you got to be thinking and saying, hang on, so I was in a bear trend, and I had a lower high here, and I had a wedge pattern, but the bulls have failed to give me acceleration. Market has turned, and that's a doji candle going sideways. So if you are in a trade at that stage, you have to get out, right? Because your thesis has been proven wrong. The thesis was major trend reversal. Bulls are taking control of the market. I've looked at everything else on the left. The bears have failed to give me acceleration down. So let me jump into the trade and see how far we go. If it fails, then you get out. Okay, if you're able to make the decision correctly, you can get out. Hopefully get out at break even, or if you wait to see what happens and you get that candle, you get out. If you don't have to wait for a stop to get hit, because the major trend reversal, your thesis, your rationale has been nullified, so you must get out. But for the purpose of what we're talking about here, now you have a lower high double top. So I hope I said lower high double top here, not double bottom. In any case, a lower high double top. So now here, the market has turned. So that was a key turning level at the 10 EMA. Now we have another lower high, or you could have said, just slightly high double top here. But that's a key level, because the bulls that have built up this whole thesis for a reversal have been repulsed at that price level. So that's a significant level. Okay. And once you mark that, and when you have a look to the left, and you kind of said, oh, okay. So that level was always significant for the market, because we had a very strong bear breakout. We had follow through and another follow through. Fantastic. Everything ticks in terms of a bear breakout. And, at that stage, you haven't seen all of this, but that's a significant bear breakout. And what you're waiting for is to trade it. But now when you see this, you can say, okay, so that level, the market tried to break beneath that, failed. Okay, and we go to the moving average, the bears tried again. So the failure is around that level. That 1.19 level is a key level. So you have it in your market and you leave it, and you're looking to find ways to get into the market. Now, if you were in a long, and you've just come out of that market because your bias was long, I always recommend and don't just jump into the next trade, unless you're scalping, of course. If you're scalping, you're in, you're out, quick thinking, okay, market has turned, okay, bear case, blah, 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 put your order into the market and get triggered in. But if you're looking for the strategies that I'm sharing with you, that we are talking about, just do things nice and steadily and slowly. Make your money comfortably without stressing. If our strategies included quick in and out scalps, well, that would be a different thing altogether, and the guys would do that very well. In any case, if your bias was still bearish, or you're holding on to bearish trades, your bear trades legitimately, because you've seen the breakout, there's a measured move, you're saying the bears are strong, the market is likely to go down there. You've seen the first leg pullback, second leg, So, that's super profits, that's the worst case profits, that's how far I want to go. So if you've come out of your trades here, perfect, because of the bull case, then just wait. So let's see what happens with the bulls, okay? I'm still looking at the bear breakout. So if I look to the left, what is the most dominant feature of the chart? That's a question you're asking yourself. The most dominant feature of the chart is this bear breakout. So you're waiting for ways to try and get in, but obviously don't ignore this because this is information that's right in front of you. So you would have, if you're bearish and we're not in the market, that would have been a perfect trade to take somewhere down there. Your stop has to be up here. Okay, market broke beneath this, pull back. So you can't put your stop here. Stop goes here until we break beneath here. Once we break beneath this level and you get a pullback, then that becomes a legitimate technical place to place your stop in. So you'd have taken the trade, and it's a whole new breakout pullback, and that's how far the market would like to go. And there is a measured move of that breakout. So this level, leg one pullback, leg two, if we're waiting for that, that would have been the place to take your take profits. So when you see that, you would have said, okay, I'm going to take my profits out of the market. If you're still holding on to your trade because you want to get the superior profits, nothing wrong with that. Could have taken a trade there or have taken a trade there and say, okay, I'm going to wait to see if I get there. You just wait. You don't get stopped out. You wait. If this had gone up and broken above that level and turned, well, you would have looked for ways to get in again. But it didn't. It bounced off just below that level. So that level that we saw here, which on hindsight, we look back and say, okay, that's what the market was doing. But now that's now all of a sudden becoming it has become a significant level. 2 attempts, or if you call that cluster 1 attempt, although there were several attempts here over 4 days to break above that. So all of these candles at some stage would have been very strong bull candles in the day, but the bears would have come in with a pretty strong selling into the close. And here creating a bit of an outside day. So, 4 days of failing to break above that, but you could call that cluster 1 as well. Remember, I mentioned that when I'm trading, look at trading, I like to see clear separation. It doesn't matter whether it's a daily time frame or the 5 minute that I trade off. Whenever I see a setup, I don't jump in and say, oh, okay, hang on a second. The market's bounced off that, double top. So that means this. I need to see clear separation. So if we didn't have all of this and a lower high here, this was the first touch we had. I would wait and see, wait for a clear separation, which when I'm trading on the 5 minute, I'm looking for at least 6 candles of separation. So now we have almost a perfect double top in that zone. So if you're bullish, if for any reason you've gotten into the market here, you clearly should be looking for ways to get out, because that you cannot ignore that double top here. I mean, lower high, double top, and confirmation. If you're not in the market, if you've taken your profits down here, or you're looking for ways to try and get into the market as a bear, then all we're waiting for now is we want the market to give us the setup that we're going to trade. So now it just becomes a waiting game. And again, whether it's this time frame or whatever time frame, everything is perfect. I just got to wait to execute. There is my double top, everything's lining up. If today, if this particular candle, remember markets are fractal. These patterns we look at, they repeat themselves on any time frame. So this particular candle on the daily is this day, on the 5 minutes, the 5 minute candle, whatever it may be. If it closes on its low beneath the moving average, happy days. All I want to see is get a pullback, which is an attempt to reverse the market, test of the EMA or some kind of a setup. So this is all good. Now I want to see breakout pullback, may form after 1 bar, 2 bars, whatever. Give me a lower high here or something at the moving average. Then you can take that trade and you want to try and get down here, all these clusters. So as it stands, very good for the bears. Now we just got to watch and see how it forms. So these are key levels to watch. Now, what could happen? So you could be sitting there and say, okay, I'm bullish as far as this market is concerned. So what should you look for before you can find ways to jump into the market? Okay. There's no way I would have jumped into the market at this particular stage. I didn't get any clear setup here to jump in. So assuming you've jumped in, you have to decide what to do. But if you're not in and if your mindset is bullish, this is clearly evident that if the bulls break above here, they want to get to a measured move. Rather than they get to a measured move, then they're going to be trying to start to get to these highs here. What we had in 2021, and that was December 2020. I mean, they want to try and get there, just make this whole thing a big trading range. That's if the bulls control the market. So if this turns and closes above moving average today, and then we have a breakout, couple of candles, confirmation and pullback. Well, if you're bullish, you got to take a trade, right? Because now you'll have a higher low. It's in a trading range, but you've had a breakout. Pullback to test this level. The key thing is going to be the strength of breaking out above this level. The bulls are strong. They will have to give us a pretty strong break above this candle, either one huge candle or a couple of candles, closing above that with follow through, closing near the high, then a pullback, and then we can look to go long. Okay. If the bulls are not strong enough to break above that, they might just create another lower high, and then you want to take the trade. So these levels are very key. And you got to look at them. These are, if you like, these are visible levels of resistance and support if you're down here. And they're going to work hand in hand with the invisible levels, the hidden levels of support, the measured moves that we speak about, or the first leg pullback, second leg. Now, interestingly, also, let me just jump to gold. Okay, gold is at 3. You can count this if you want, but again, separation is an issue. But 3 distinct attempts to break above that level, 1834, that level, 1830s level, but failed. And that tells you immediately, whichever way you're trading, that's a key level to have a look at. I skipped a step. Let me just show you something. So euro, we said 1.19082. So when I go down to my 5-minute time frame, there's stuff that I'm going to be showing you just now there. But there's my level. So my level is in there. I know the key levels. I don't have to go back to look at them as I'm trading, although I'm always going through the daily setup. I've said so many times, the daily setup, high of yesterday, low of yesterday, open of the day, and then any other key levels that you have. So that's a key level. If the market, if I start to see this coming into view, I'm not going to ignore it. Okay. And if things start to happen there, I'm not going to be surprised if there's acceleration to test it. I'm not going to just jump in and say, oh, the bulls are in control. It could just be a buy vacuum test to that level. The market bounces off that. I'm not going to be surprised, say, hey, what's happening if I don't see any other levels? It is there. It is for me to trade wisely. That's a significant higher time frame. Now, off the 5-minute time frame, it's always good to just pay particular attention to the chart that's in front of you. And I just use the daily as the other reference, as the higher time frame. Man, if you want to, and I've done that many times in my early days, I look at the hourly to say what's a key level on the hourly. I look at the 240. They're all very important, but you don't have to look at the hourly time frame or the 4 hourly. It's all inferred on the 5 minute time frame. The daily just gives you a macro level view. So try and keep your charts as clean as possible. I'll come and talk about trades I took yesterday, really beautiful trade, but I want to talk about that. Let me just talk about gold, just a little bit more. Okay, so there is that level again, same kind of thing. If you did a break out beneath that and the market puts with that, you'd have noticed that when the market comes back again, there is a double top. If you were a bear in this market, they haven't seen the breakout beneath this level, breakout candle, small tail, beautiful follow through, beautiful follow through, tail at the top. That's fantastic because it was bulls with a big bull candle at some point, but the bears came in and sold it into the close. So that's good, right, for the bears. Then you just try and find ways to get in. You could have been triggered anywhere in there, but your stop is way up there. Or if you want to put your stop at a 50% pullback. So remember, stop is always at the extreme of the breakout channel. But if you want to put a 50% pullback, you can. And if you'd held onto your stop through all of this, you'd have been stopped out there, and try and find another way to get into the market. Okay. So there's two places to place your stop. Okay, so there you go. So now you see, okay, now I have a double, well, let's put that in there. Okay, so before all of this had set up, there's a 50% pullback. Remember, if you trade in any breakout, the most important thing is a 50% pullback. And it's preferable that 50% pullback has to occur, pretty early on in the next 6 to 7 or 8 candles or so. It's still significant, but the more the price goes sideways, it is not as solid a level as it would have been if, for example, if you trade in a news breakout and you see this kind of breakout, and the market comes back and tests at 50% and resumes down, you gotta just jump in and trade. Still a level. Now, when you see that double top, I say, okay, fantastic at 50% level, but let's see what else happened. Then I see, okay, there's another double top. So that first double top is a double top with the invisible level of 50%. But now I can say, okay, there's a good double top. So this is a pretty strong level so far. And you're trying to find ways to get into the market. You could have put your entry there. I don't know, might have been triggered there, whatever the case may be. But if you put in your entry there, where do you put your stop? 2 ways to put your stop, okay? With the breakout pullback, we haven't had another breakout beneath this level, so we can't put our stop here. If we'd had a breakout beneath this level, market comes back, creates a double top, you can put your stop there because that becomes a significant level because the bears have broken beneath this and they're going to defend that. Likely chance of them defending that. But because that hasn't happened, here's where you can put your stop. Your stop can go up here, pretty logical, boom, put your stop up there. Or you can say, okay, I'm going to take this trade. If the bulls are strong, I take the trade, I get triggered in, and the bulls reverse the market. If you're a bull, where do you want to take the market? Okay, the first objective for any bulls is a measured move, breakout of any trading range, right? The first objective is a measured move. And I'll keep speaking about this over and over again. So you think, okay, the bulls want to go that far. So if they want to go that far, then put your stop a little bit above that. Okay, that's where you put your stop, which, you know, it's a slightly tighter stop than put it up there, but that's the correct place to put a stop before we have a breakout beneath a previous low. So don't place random stops, guys. I mean, you just it messes up your the risk return that we talk about. So if we say take a trade according to strategy, if it's anything else but a major trend reversal, 60% chance of success, sometimes it's better. That assumes you put in your stop at the correct level. Okay, if you just place your stop randomly and say, well, it's going to go my way 60%, the market does pull back. And that equation or that formula, that risk return that we're working on will be skewed, and you can end up losing money. Always put your stop in the correct technical level. And just, you know, if you can't clearly see it, just think, okay, what would happen if I take a trade and it goes against me? You know, that's when you can put it there. And if you're not sure, just go to the nearest technical level to the left and place your stop there. Where to see what happens. And of course, the other side of that, while we're talking about it, you saying to yourself, okay, if I'm correct and the bears accelerate and break beneath this trading range, they're likely to get to a measured move. So measured move is down there, which is almost like that low. So, you know, market broke beneath that, and you can see all of that. Okay, bulls trying to reverse it, but also profit taking. And if you just wait for them, they can be quite clean. But the key is to wait. The key is to wait. Okay, so you have your level. So that's pretty interesting. So, you know, nothing, you know, for the way that you trade for bulls to get in this particular market. If for any reason you kind of got in, you see in that level, you can't ignore that level. Okay. At this point, we're saying, okay, bulls are strong, close above moving average, follow through, and there's a pullback. And, you know, if you thought you could get in that, you were not triggered. But if you're triggered, your stop is down here, you know, where you've got these tails, or down here, but I would put it down here because of the buying to the close. Remember, I also said you can also get clarity by clicking your line charts. The reason we do that is that line charts are based on closes. So if you want clarity, sometimes just plonk in the line chart. Where do I put my stop? Because I've got all the tails at the bottom. You can put your stop down there. Okay, so it's just a line chart that I just clicked in. Okay, so if you'd been triggered, we were not. If you had been triggered, stop down here. You can't, you know, put your profit up there when you have such a key level of resistance. Okay, then what do we get? What we get is, okay, the bulls have given us a close above the moving average. The bulls are strong, well, you know, break out above here, pull back, and we can trade you long. But we then get a wedge pattern, 3 attempts by the market to break above a particular level. Why would that be happening? That's because the market is giving us information that we are coming to a key level that's been defended. There's 3 attempts. First attempt to accelerate fails. Second attempt fails. Third attempt fails. So 3 attempts to accelerate behind this level. That's a wedge push pattern. And you've seen all of this. Now you know, okay, so 1834, that range on gold is pretty significant. I need to make sure that you know, when I get to my 5-minute time frame, that I've got it marked there. So if we ever get to there, it's already indicated from. That's all I really need to mark off that the time frame. We'll get to this. Yep, we'll have enough time. So that's what you need to mark on the daily. Now, remember also our daily setup. So I would have these key levels that are evident. That oh my goodness, I've got to make sure I'm aware of this, these levels here. Then, of course, for each day, high of yesterday, low of yesterday, and the open of the day. Key levels that you always need to put on your 5-minute time frame. Okay, so sorry about that. Calendar should be off. So wedge attempt failed. Then what do we get? We have the bulls trying to attempt. Again, no follow through. Bounce off the 10 EMA, we're in a trading range going sideways, so not as significant. Then we have a pretty strong bullish attempt to break up above that level. At some point, the market got to 1833.9. It was virtually there in 1834. But the bulls failed to just give us a couple extra cents or dollars above that price and give us a close above that. I said, oh, wow, the bulls have finally given us a close above this level. But they failed. They were repulsed. So that's a very key level of resistance. That's going to determine the direction of the market until we have a break above it. The market's not going above that at all. Inside candle, indecision, pause, whichever way you may call it, and a huge bear breakout yesterday. So, of course, if you're bearish, you're now expecting bearish price action and waiting to see if we get an opportunity to trade. The opportunity, of course, would be we love this bear breakout. Let's see if we get a follow-through candle today, just closing near its low. It doesn't have to be a huge candle. Then give us a pullback and we jump in, we take a trade and look at taking our profits down here. So although this is a daily time frame, the reason why you've got to notice these things, they will influence the market forces at play on the lower time frame, and you cannot afford not to know about them. You just have to have the sense that they are there, okay, so that we trade wisely, we make more money, we lose less, and we get the huge returns that we're pursuing. All right, so what I want to do, I just want to show you something. For a while I have spoken about how to get into markets using orders, how to place an order in the market. But I think I just want to show you another way of trading, of getting into the market using limit orders, limit order entries. So you limit, well, let me explain it. Let me explain it. The safest, let's call it the safest way. And I say safest because you know our probabilities, the trader's equation, risk, reward, probability. We can control our risk. We can decide how much of our capital we invest in the market. So, if you've got, you got 10,000, you got $1,000 in the market, okay? You can decide how much you want to risk in the market. It's up to you to say, okay, I'm going to put 1% in the market. I'm going to risk $1 in the market, $10 in the market, $15, $20, whatever. That is up to you. You can make that decision. If you got 1,000 and you're risking 1%, it means you're taking $10 of that, and that's what you invest in the market. And if you then get a one-to-one return, you put $10 in, you get $10, 100% return. Absolutely fantastic. Then we just want to do that often enough. You get 2-to-1, that's a 200% return on the money that you have invested in the market. And the best way, the safest way in our strategy, 60% chance of success, sometimes 70-75, is to place orders in the market, sell stop orders or buy stop orders. Here is an example. Okay, so on this particular trade, which was yesterday, I used a sell stop order. I put an order in the market, and I said, if the market goes in my direction, boom, get into the market. And if I'm wrong, this is where I can stop that. If I'm right, this is where I take my profit. So just a quick one. So breakout, follow through. Hey, I'm happy days. I'm now waiting for a pullback to the 10 EMA. If I get a pullback to the 10 EMA and a decent reversal candle, I want to take that trade. Okay. But part of the point of this is that, sometimes you have to wait a long time to get a trade. Sometimes you're not there in the market, you're doing stuff, you're working and you just don't have it, or you're running errands or whatever the case may be. But when it turns up, when this turns up, when you are in the market in a particular session, so you could have gotten up early. I love to get up early and look for opportunities in the Asian session. So that's crazy time. That's like 2 a.m. my time until 5:36 when my household comes awake. Or I can wait for the US session, which is absolutely fantastic because opens my time, 3:30 my time, and the first couple of hours, things could be happening. 5:30 I'm home. I could trade the US session for 4 hours. So things happen then. When this set up, you got to take the trade. Can't hesitate. Okay, there's no perfect thing. So this happened to look perfectish. It looked perfectish in terms of our strategies. When I say perfect, in terms of being 60-40 success, right? Not 100%. So breakout, confirmation, pullback off the 10 EMA. Bulls tried to fail it, failed, close near its low, put an order here, sell, stop, order beneath here. 1 pip, that's what I use. You can decide you're going to put 1 pip, 2 pips beneath. Does not matter. Stop is up here. And where do you want to take it? Well, the measured move of the breakout is, there is a breakout, there is a measured move, that's a take profit. The ultimate, the maximum profit you can take. Or first leg, pull back, second leg, there is the extension there. So you can put your take profit in between. So decent entry 1-to-1, boom, you get your 1-to-1 return in whatever, less than an hour. But that you must take. These breakout pullbacks, lower one, lower high, you have to take this, because these are the ones that I say sometimes when you set up, it's the probability is now in the 70% chance of success. So, but this we've spoken about. Now, another way to get into the market is to use limit orders. So a stop order is where the market is going my direction, boom, get in and trade. But a limit order is saying, okay, the way I've read the charts, I'm happy with it, but I want to get an even better entry. I don't want to take a stop order entry. I want to take a limit order entry. So when the market is pulling back and going away from the direction I want it to go within the context, in this case of a bear trend, I want to try and get into the market. So let's use this one here for the sake of not cluttering the chart. So you didn't take that, or you were not there, okay? And you come in and you see that, and you put your entry 1 pip beneath that, and let's say you're not triggered, but you want to get in because you say, listen, the whole thesis that the bears are controlling the market. I want to get in, and if I don't find a way to get in, the market can just start to accelerate down. And I don't want to get in too low, towards the profit level. So what you then do, because of the context that you're looking at, you set a limit order. In other words, you say to the market, instead of getting me in between here, I want you to get me when the market pulls back. So it's pulling away from the direction I'm expecting to go. Set your limit order, stop at the same level. Now, if we're going to try it out a few times with the lowest possible risk, if you're risking 1%, go and risk 0.01% if you can, okay, just so that you get familiar with it. And it's not difficult, but it's a psychology that you need to work around. So at this point, you put your entry above there. I'll show you how it actually worked on my gold trade just now. So you put your entry above that to say, okay, if the market pulls back again, and as long as the market, my entry does not take out that, if market pulls out again, please trigger me into the market. I know it's going against the market, but my stop is here. I'm very happy for the market once I'm triggered to go back, because I know my stop is I'm going to rely on my stop. I'm going to rely on my stop. Always have a stop in the market. And why you need to have strong psychology? Because you get triggered and immediately you're showing a loss in your account. Whereas if it's a stop order, when you get triggered, chances are the market goes your way and it's a bit of profit and maybe a bit of pullback later, but you start off with a bit of profit and you're okay with that. So the market can pull back against you 1, 2 candles. But then look what happens. You then have this massive candle. So what would have happened is you'd have said, if I don't put a limit order in the market and the market starts to accelerate down, I don't want to take a trade close to my take profit. Okay. And that's what you're trying to avoid. So you get triggered in there, market pulls back a couple of times, then it accelerates. Now, if you are waiting for a nice reversal candle like this one, pretty high up off the EMA, you don't get it. The market has moved, and this could even have been lower, closer to your take profit level. Then you say, oh, well, I can't take it. And that's fine. If you're not trading with limit orders, and if it's like that, you don't take the trade. So you'd have gotten in a little bit better than here. So why better? Because your entries here, stop is there compared to here, and stop there. So opportunity to make a lot more money. In any case, so that's limit orders, that compared to that, right? If in any case you decided, okay, I don't trade limit orders, I don't get it as yet, but I've missed the market, I've come in, done my analysis, there is a potential take profit level. If I see that, where is a measured move? Well, let me take a trade, I'll take my profit down here. You could still do that. And at that stage, you can put your stop here, get your 1-to-1 return. That's fantastic still. But the point here is the fact that you have an opportunity if you start to learn how to use limit orders. So let's assume that's gone by. You come back from wherever you've been running errands, pick up your keys, do whatever it is that you need to do with life, and you get down here and you see this opportunity and say, well, how am I going to absolutely trade this? Market attempts to break out, good for the bulls, break above the moving average, follow through, and you expect, okay, the bulls are strong, I'm going to get a pullback to the moving average, but the bulls try to break up, but that fell. Now we have a lower high. From this breakout, we have a lower high, but you're not ready to trade that because you're saying, okay, it is a lower high, but this particular move ended here with a wedge pattern. 1, 2, 3. Market tried to go down 3 times after breaking beneath here. So this particular pattern is ended, but it's still a legitimate lower high. I'm not going to take that trade. I'm going to wait to see if I get a second opportunity to get into the market. Close beneath the moving average, very important, nullifies the bull case. Then you get a lower high, the 2-bar reversal. That's a trade you could take. Okay, so you could take that particular trade in this case because you're not taking lower high. You can put your stop here, okay, and aim to get there. So that would have been fantastic. Now, in terms of where you could take your limit orders, let's have a look at this one. That gives you a cleaner opportunity. Lower high, 2-bar reversal, inside candle. Very decent one that you can take. That's a low one, the first low entry after the failed breakout. So that would have been equivalent to taking a trade here if you wanted to take that particular trade. But there is a low one you can take. If you're taking that, your stop has to be up here. If you decide to take this one, your stop has to be up here. But when you're taking a second entry, that would have been the second entry. First entry here, second entry here, you can put your stop here. First entry, stop has to be up here. Second entry, you can now put your stop here. But here's what's interesting. So you've seen that, say, okay, I didn't take that trade, maybe I should have, etc. I follow through, I would have been triggered in. So what do? Do I wait for the market to accelerate down and pull back before I get into the trade? Or do I find another way to get in? This setup is fine, but now I'm trying to find a way to get into the market. So what I then do, there's my entry, there's my pullback. Instead of waiting to see if the market will give me a reversal candle, let's say this kind of candle, instead of waiting to see if I get that kind of candle here, I can put a limit order and say to the market, okay, I'm happy with the whole context that I've got. If you go against me, limit order here, trigger me into the sale. I'm going to rely on my stop, okay, because that's a better entry than for me to wait to see if I get a 2-bar reversal somewhere way down here. So you could have been triggered here and, measured move, wait to see if you get, let's block it in. Okay, so you would have been hoping. Okay, there's my 2-bar reversal. I'm taking the trade here. My stop is here. I'm hoping to get down here, but you wouldn't have gotten down here. At this time, market would have turned on you. And if you didn't get out there, you can try and get out somewhere here. Or if you said, okay, that's a higher low, that's a higher low, or that's a low that's significant in the market. Remember, this low is as of yesterday, so you would not have seen this because this is today's market. You could have taken your profits off here if you're quick enough. If not, you might have had to, or you wouldn't have been stopped out, but somewhere during the day before the close, you'd have had to get out probably a break even. Let's have a look at the limit order. So on euro, my trade was a stop order trade. I didn't use the limit order because I was already in the trade. But on gold, gold was interesting. So I came into the market somewhere around midday. So all of this, I'll talk to you about just now. All of this occurred before my time. But by having a quick look at it, fantastic. The market is selling off. It's a bear market. I've got to find ways to get into the market. So at this reversal, if the bulls are strong, they'll get to a measured move. And sure enough, we got to a measured move. But look at all the tails that were created. What do those tails indicate? Those tails indicate a lot of selling. So the bulls were strong. So if you jumped into a bullish trade here, which I didn't, if you jumped into that for whatever reason, you'd have said, oh, fantastic, bull breakout, follow through, another follow through. Oh, okay, but hang on, what's happened to the bulls? Why are we getting all these tails? If the bulls are strong, at least we can have a pause, profit taking, etc., or a test of the EMA and then resumption. But the fact that we're having all these tails at a measured move, and if you keep looking to the left and saying, okay, hang on a second, maybe the bears are strong. There's a level of resistance in here that the bears are defending. So when I saw that, I was quite happy to say, okay, now that's good. That means the bear case is strong. I got to find ways if it sets up for me to jump into the market. So this is what happened. Then we had an inside candle, and I'm like, okay, good inside candle, bearish body, but it's not strong enough. I'm not going to jump into that. Let me see what else I get. Then we had this strong bear breakout tail at the bottom. But look at the body, close beneath all of this selling that we had, selling into the close, tails on top, close beneath the 10 EMA, close beneath the 20 EMA. So the 20 EMA is a dotted one and the 10 EMA is a blue one. So these EMAs, exponential moving averages, the 10 is an indicator of the strength of the breakout, the way that I use it. So the fact that it was rising means bulls were strong, but all the bullish action was reversed by that candle. But now I had a dilemma, and I'm saying, okay, hang on a second. What do we do? As it is forming and it's closing, you got to be thinking, do I wait to see if I just get a test of the moving average and then look for an order to get in. So one of these, for example, or maybe I get something like that. But what if I don't get it? Okay, let me put a limit order in the market. And that's what I did. So all I did was say, okay, I'm going to put a limit order. In other words, if the market, so my whole thesis at this stage is that the bears are strong. Okay, so the market is selling off, so the bears are strong. And that selling off is at a measured move. Fantastic. There to be, so there's resistance there. And it's a lower high, etc., etc. So if the bears are strong, here's my thesis. Even if there is an attempt to break above that, the bears will resist that. The bulls might try and break out, but the bears will resist that. Otherwise, I would be wrong to be one of those 60-40 trades that I'm taking, because I'm looking to trade with the trend. So put the limit order there. Question is, where does the stop go? Well, stop has to go to a measured move. Okay, so either put your stop at a measured move or you look to the left. And the only other place to the left you could have put it was somewhere here, which happened to be almost the same as that. But I didn't look to the left. I said, here is the key price action is a market going sideways. Okay, it tells here inside candle, outside candle. So there's a trading range that formed there. If I was to go to a lower time frame, which I don't. But if you were to go to a 2-minute or 3-minute time frame, or even the 1-minute time frame, you might see a perfect trading range that formed here. Then you say, oh, okay, that's a trading range. So if the bulls are strong, they're going to like to break above that to the trading range. And let's put my stop within there. So my stop would have been above here. So that's probably not as accurate. So I put the entry in, limit order, limit sell. So in other words, the market is going against me. I'm very much okay in my mind for me to be triggered and see a little bit of loss if that's what it takes. So I did, and then it ended up as, so started here, strong bull candle, got triggered in, and closed still pretty high up. And it's like, oh, that's interesting. Maybe this is one of those chances, though that 40% chance that I'm going to get stopped out. Bulls had a pretty distant follow through, okay? But you got to remember, why would this make sense if you think of a trading range? Remember, if the market is in a trading range, your trades in a trading range is whenever the market is near the high of the trading range, and you've got your double top, and then you see the entry, you want to sell at the top of a trading range, and you want to sell into the trading range. When the market gets to the bottom of the trading range, and you got your double bottoms and higher lows, etc., you want to buy at the bottom of the trading range into the trading range and take your profit. So selling at the top of a trading range makes sense, okay, because you're selling back into the trading range, which means the inverse of that, buying at the top of a trading range, doesn't make sense. So my thinking is, okay, I'm very happy with my limit sell, and I see that it's a bit of a concern, but I'm not concerned. The bulls would really have to be super strong to buy at the top of a trading range and create a successful breakout. Can they do that? Of course, 40% chance that my strategy may fail at this particular moment. But then, you just leave it and wait to see what happens. It might get a follow through, and then turn. But as it happened in this case, immediately, right off the top of the trading range, there was massive selling, okay, all the way down to hit take profit. So get triggered in 1, 2, 3, 4. By the fourth candle, you've already hit your take profit. Now, the point is, had I waited for a stop order entry, which is fantastic, that's all that I'm trading, there would not have been anywhere for me to trade here. I think a few times you heard me say, there's no way for us to trade here, and that's, we are using stop orders. There's no way for you to trade. You can't, put a stop order here and your stop is up there and try and get 0.25 of a return. I mean, I wouldn't do that. I wouldn't do that. So that's use of limit orders. Now let's have a look at how you could have taken this. So if you're in the market and you see this breakout, follow through, pull back, put your order beneath here, not triggered. And if all you're trading is stop orders, perfectly fine. If you happen to be triggered here, which I doubt, because maybe you would have been, that's fine. Just stay in the market, okay? Stay in the market. Even if it goes back to test moving average. If you're not triggered and you're waiting for a stop order, wait. That would have been, that's a beauty, that this is one that you teach your kids. Just listen, go and watch the charts. And if you see the market going back and there's alternate red and green and it hits this thick blue line and there's a red candle that's closing its low, just press this button. That's what you teach your kids. Easy. You could have taken that trade and wait for the, leg one, pullback, leg two, which we go to, measured move, etc. But limit orders, you say, am I going to wait? What if I wait and hopefully get a pullback, the market accelerates down, which it could do. It could have been this candle and that candle. I'm not going to chase it all the way down here. Where can I put a limit order? In other words, where am I comfortable with my analysis of the market to put an order in the market that says the market pulls back, goes against the direction that I intended to go? Trigger me into the trade. If I'm wrong, stop me out at this level, because if I'm right, the market will accelerate. I'll get a better entry into the market. That's exactly where you would have put. So, like I did here, you could have put your limit order here and your stop could be there, up there, or 50% pullback. Okay, so you could put your stop at 50%. At just above 50% pullback, because you're saying, there's a breakup, the bears are strong, they're going to defend 50% pullback. Happy with that. I may get stopped out a lot more often than if I put the full technical stop. That's a choice you got to make, but there's a full technical stop. 50% pullback is also fine, just above it, but understand you get stopped out more than the full technical stop. That's where you'd have put your limit order, and you would have been, so limit order above this candle, you'd have been triggered on that candle. Okay, that's how you trade that. So as we go forward, I'll show a lot more of limit order trades, which I've typically just left out because I think if you were to ask me, George, where do I start? You've got to start with stop order entries. You've got to start with the stop order entry that says, if I'm going long, and I see my setup, I'm going to put the order a couple of pips above that green candle, that bull candle. And if you go in my direction, trigger me in. If I'm selling, going downwards, I want to put my order just below that candle. As the market goes beneath, trigger me. Get that right 100%. If you get that right, then you can start to play with limit orders. And that combination, you just start to see a lot more things in the marketplace. Well, guys, just check if there are any questions. No questions. So thank you very much, and we shall see you next week. Have a good time. And thank you, guys, in the office. Appreciate your time. Thanks, guys. Take care.